In this video, we're going to get into the next advanced topic with our merger model, which is actually combining the balance sheets of the buyer and seller here. So taking Apple's balance sheet over here and then combining it with RIM's balance sheet over here. Now, on the surface, this is fairly easy and similar to what we saw in the first part of our merger model tutorial, where we combine both companies' income statements. For much of the combination of the balance sheets here, it's actually the same thing. We're just taking one item from Apple and adding the corresponding item from RIM. So many of the items here will be the same. But not everything is going to be exactly like that, and it actually gets more complex than combining the income statements because we need to create some new items as a result of this acquisition. To illustrate why exactly we need these new items, in this first video, I'm just going to go through an example of how we would go about combining the balance sheets, and I'm going to show you why we run into a problem when we combine the balance sheets and simply add together each item here. And you're going to see why when we do that, in most cases, the balance sheet is not going to balance correctly. And that is going to be why we need to create some new items to take care of this. So to get started with this, let's actually go through and begin combining the items here on the asset side and then the liabilities and shareholders equity side. So our approach here will be to take the buyer's number and then the seller's number and then simply add them up in the combined column here, and then also add in the adjustments column. Right now the adjustments column here is completely blank. We'll be getting to this later, but that is really all it comes down to. We will be filling in adjustments for a few of the items here, but for the most part it's going to remain blank. But in a few cases here we will need to make a few adjustments. So to start with, let's just take cash and short-term securities. So this one, the combination is very simple. The only hitch here is that in the adjustments category, remember that when we go and acquire a company, we're using cash to do it, or at least partly cash, as we see up here. So what we need to do in our adjustments category is subtract here the cash that we're using. So I'm going to link to the cash used number right here. And I'm just going to enter a minus sign in front of that. So we see that now our cash balance is about 14 billion lower as a result of spending this money to acquire RIM. So now for the rest of the items here, accounts receivable, deferred tax assets, and then other current assets, these are all very simple, and all we're going to do here is just do a simple combination. We're not going to fill in anything in the adjustments column for these because we don't need to yet. And in most cases, we don't need to do anything here at all. We're simply combining these items as is. So let's add up adjustments and then combined here. So we have 30.6 billion of combined total current assets. Now, next on the long-term side here, so we have securities, PP&E, goodwill, other intangible assets, and then other assets. So let's get started with combining these. We're going to take the exact same approach with simply taking our formula right here, adding together the buyer and seller's balance sheet, and then making adjustments. So I'm going to copy this formula down and then sum up these items. Remember that we also need to add in our total current assets above. Just pressing F2 and our calculation here looks correct. Copy the formula for the adjustments column as well. So far we have 42 billion of combined total assets for these two companies. Now on the liability side, we're going to take a similar approach, and for most of these items, we can simply combine exactly what you see here, and we won't have to do anything too fancy. So let's take this formula and copy it down for the current liabilities, and then also take this formula and apply it to the long-term liabilities right here. I'll add up current liabilities, and then I will add up long-term liabilities and then add the current liabilities to get total liabilities. Now in terms of adjustments here, we don't really have anything on the current liability side. We're not going to generally adjust accounts payable, accrued expenses, or deferred revenue at the instant of a transaction taking place, so we're not going to adjust any of those. On the long-term liability side though, we don't bother with deferred revenue or deferred income tax liabilities or other long-term liabilities, at least for now. But one thing we do want to do is reflect that we have to raise debt to acquire RIM as well. So let's go back to our merger model, and I'm going to link in directly from the debt issued cell right here. So we need to reflect the fact that we're raising 14 billion worth of debt to complete this acquisition. So we have 32 billion worth of total liabilities for this combined company. Now, for shareholders' equity, we're going to take a similar approach, and we're just going to start off by combining both the company's shareholders' equity categories right here. So you see I've just copied this formula down. I'm going to sum up everything right here. We have 38 billion of shareholders' equity, but actually we do need to make one adjustment here to the shareholders' equity category. And the reason we need to do this, remember that when we combined the company's share counts right here for diluted shares outstanding, we didn't take the buyer's share count and simply add the seller's share count. Instead, we assumed that all the seller's shares essentially went away. So we assume that this 560 million worth of diluted shares outstanding for RIM, that all of these shares are simply gone. They vanished and they are no longer in existence. Since we always reflect that fact, and since that's how we pretty much always do merger models, on the balance sheet, what we have to do is assume that the seller's entire shareholders' equity balance here also goes away. So literally what we're going to do is take the negative of each of these items, and we're going to ensure essentially that when we combine the companies, that the seller's shareholders' equity completely goes away here. So I'll just copy this formula down and then sum it up right here. So we see that our total shareholders' equity is actually exactly the same as Apple's, which makes sense because we're assuming, again, that the seller's shareholders' equity completely goes away here. One other adjustment we want to make here is that, remember that when we made our assumptions for our merger model up here, we assumed that there were new shares being issued as well. So we want to reflect this fact. Now, in terms of the value here to represent, we don't want to just add the number of shares issued. We need to reflect the value of those shares. So instead of adding the 74 million worth of new shares here, we want to reflect what that is in terms of Apple's share price times the number of new shares issued. And we're going to be adding that to the APIC line item right here, additional paid-in capital. The reason we're doing that is because Apple's common stock, their par value is so small that even if we added in something here, it wouldn't matter. Remember that APIC, going back to our accounting videos, represents whenever a company issues stock, it represents the value of the stock over par value. So when a company goes public, the funds would show up here. When a company issues stock in a secondary offering, or when a company issues stock to buy a company, the value of the stock over par value would show up in additional paid-in capital. So in this case, we're just going to make a simplifying assumption and say that the entire value of this share issuance goes to additional paid-in capital. So what I'm going to do here is actually add to this number, and I'm going to add the percent stock right here times the equity purchase price right here. So we're adding in around 14 billion of additional paid-in capital here. So we see that now our shareholders' equity has gone up by around 14 billion versus the value that Apple initially had for their own balance sheet. So we have that in place, and now let's just sum up everything, total liabilities and shareholders' equity right here. So we see it comes out to 78 billion, and we have total assets of 42 billion right here. So, as you might have already guessed, we have a problem here in that our balance sheet is wildly out of balance. So we'll take the 42 billion and subtract the 78 billion. So it's out of balance by around 36 billion in this case. Now, the reason why this happens, if you want to think about the math here. So what we're doing is we're taking two balance sheets that are already in balance right here, the buyer and seller's balance sheet. These are already both perfectly balanced. What we're doing is we're taking 14 billion out on the asset side. So that's fine so far. But then on the liability side, we're adding 14 billion to the debt right here to liabilities, and then we're also adding the 14 billion here. We are taking away the shareholders' equity of around 7 billion, but when all is said and done, essentially what's happening here is that we're taking away 14 billion on the asset side, and then on the liability side, we're adding 28 billion from long-term debt and from additional paid-in capital, and we're subtracting shareholders' equity of 7 billion. So when all is said and done, assets here has gone up by around 14 billion, and liabilities and shareholders' equity here has gone up by around 21 billion. And so that's what creates this imbalance of around 35 or 36 billion on our balance sheet. Now, why does this actually happen when we combine the balance sheets? Well, One way to think about it is that when we pay for this company, the price we pay should be roughly equivalent to the shareholders' equity of the company. So if we were going in and we were paying just 7 billion or 6.987 billion for RIM, then actually our balance sheet here would balance because we're taking this away, we're adding a few items to the liability side, and then we're subtracting something from the asset side right here. So if we were paying exactly the shareholders' equity for this company, then our balance sheet would balance correctly. But instead what's happening here is that we're paying 43 billion for the company. This equity purchase price far exceeds the shareholders' equity value right here. It's only worth 7 billion according to the balance sheet, and yet we're paying 43 billion for it. And so that's what creates this wild imbalance. If you want to look at the numbers yourself, you can just take the 43 billion right here and subtract the 7 billion right here. You see it comes out to the imbalance of around 36 billion. And as a result of this, what we need to do is look at another item on our balance sheet, which is called Goodwill. And you see over here on the asset side, we already have some Goodwill. The purpose of Goodwill, going back to our accounting videos, is for this very scenario, when we pay a lot more for a company than what its balance sheet actually suggests that it's worth. And what we need to do in this case is we need to adjust the value of Goodwill and some of the other items on our balance sheet to reflect how much we're actually paying for RIM and to reflect the fact that its value far exceeds what you would think just by looking at the shareholders' equity on its balance sheet. So that's why we need Goodwill, and that's why we need to create some other items in the context of a merger model like this, because oftentimes what we pay for a company, the 43 billion here, far exceeds the shareholders' equity of around 7 billion. And so to take this into account, to fix this and to make sure that our balance sheet balances, we need to look at Goodwill and possibly creating more of it. We need to look at intangible assets, and then we need to look at other items such as deferred tax liabilities, and then we need to make adjustments to balance sheet items. So we need to adjust the values of some of these other balance sheet items to take this into account. And so that's what we're going to be getting into in the next video. We're going to be looking at each of these, and we'll be seeing how you actually calculate Goodwill, how you calculate the change in intangible assets, other line items, and how you calculate the amount of new deferred tax liabilities that are created in a transaction like this.